had effectively, and thanks for joining me, by the way. I'm in the Raleigh office this evening. As you can see, the Raleigh skyline behind me a little bit. So we've had the stock market, as identified by the S&P 500, do fairly well this year. And so we've had a lot of clients say, geez, why isn't our portfolio up 7%? Well, the first answer is, of course, we're not invested all in U.S. stocks. We have bonds in the portfolio. We have international stocks in the portfolio. And as you can see, this purple line here, a pink line, I make it a little thicker, that's international stocks. And international stocks are down 10% this year, the EFA index. So we've had this divergence. Now, that's a little bit unusual. If you go back, there's been a high correlation between U.S. stocks and international stocks. Even if we look at, say, the last 5 years or so, the U.S. market has kind of taken off. If we look back 10 years, usually when U.S. stocks are doing well, you can see international markets 10 years ago were outperforming U.S. stocks, and then it kind of came equal. And then we've had, over the last, since 2011, we've had this divergence where U.S. stocks have continued to rally and international stocks have not. That's really been the case this year, too, where international stocks have really underperformed U.S. stocks. The second part is junk bonds. As you can see, this thick line, I just have JNK, which is an ETF, which shows the junk bond market, and HYG, which is also another high-yield bond market. They also went down. If you look at the last, say, 3 months or so, high-yield bonds were chugging along pretty nicely this year, up about 4%. And then all of a sudden what happened was high-yield bonds came down during this downturn that the stock market came down, but didn't recover, right? So we had the stock market effectively year-to-date is up 7%. It's come down and then recovered back very nicely. That hasn't been the case with the junk bonds, and that hasn't been the case either with the international stocks. You see kind of international stocks sort of rallied a little bit and then subsequently fallen back down pretty significantly. So we've had this divergence. The important thing, of course, is to start from what's knowable. Now, as an economist, you'll have everybody on TV. You could probably see the CNBC, Jim Cramer yelling and screaming about something behind me there. And the reality of it is that nobody knows what the market's going to do in the short term. Anybody who says, I could get on TV or radio and make an estimate and say, okay, this is what I think stock prices are going to do. This is what I think oil is going to do. Nobody knows. And so I always come from the I don't know school. And we look at things honestly and we say, okay, what if the economists, what if the analysts are right who have a very bear case scenario, a really bad case scenario? What if the ones who are very bullish, what if the ones who feel that the stock market is going to do very well, what if they're right? And what if our estimates pan out to what we think is going to be the case, which is generally the truth being somewhere in the middle is what we think. So what we do is we analyze for those three scenarios. And as you can see, if oil prices plummet down to $40 a barrel and if the economy goes into another deep recession, stocks do very, very badly. Again, it's nice that, right now everybody feels okay and feels good that the stock market is up 7% or down a little bit after today again too. That never matters to me again in the short term. Makes you feel good, and I get paid a little bit more. Our firm gets paid more when your portfolio values are up, but that doesn't matter. The key to us is get you a continuous stream of income. So we've been through this before, right? When we look at the horrible crises we've gone through over the last decade, it's nice that we've doubled our clients' money, but more importantly, these green triangles kind of show you that we've gotten you that steady stream of income so that you've continuously had the nice, none of our clients had to go back to work, none of our clients had to change their retirement, and those who were reinvesting their dividends and interest, we were able to profit well during the financial crisis when stock prices sold off horribly, or the two European crises that we've had. And now we could throw another crisis in here and call this the energy crisis. And this brown line could very well come back down to, we could have a 20% correction. It's quite possible. We don't really know, right? I'm not going to come on here and say I know what's, because nobody has a crystal ball. Nobody knows for certain. So that's why we hedge the risks that are out there. We hedge the risks that are knowable, and we look at what's possible and what's probable. And it's possible that stocks lose 25% over the next 5 years. It's possible that European stocks lose 25% over the next 5 years. More probable, and one of the reasons why you're seeing us shift out of U.S. stocks, some of the companies we've sold recently, and buy some foreign companies, is because our base case for U.S. stocks at current prices isn't great. It's only about 3% returns. Now, again, this is why dividends are so important, why we don't buy companies like Tesla or companies that don't pay dividends that are too expensive. European stocks have a nice base case return of 10%, which is a lot better than U.S. stocks. And even on a day like today, if you look at a day like today, just to show you, like, again, this is micro term. It's been a massive sell-off here in the short term. U.S. stocks lost money today. They were down, I don't know, 0.5% or whatever they were down. You can see our stocks lost 0.44%. Microsoft was down the worst at 3.24. Best performer was a stock that I just recently bought for you, Phillips 66. Again, because of the energy crisis, it was up 3% today, and a lot of energy stocks were up today, like Marathon, which we recently purchased also, and Conoco. So even though U.S. stocks were down, international stocks actually were up 1%. So a lot of times what we hear from clients is, geez, why are you buying Royal Dutch? It's down this year. Buy more Apple. Well, the reason is Royal Dutch is a lot cheaper than Apple now. We were buying Apple when everybody hated Apple, right? It was nice when we owned it. Apple's up 51% since we purchased it back in 2012 when everybody hated it. And it was down today, so it's kind of run up a lot. It's getting a bit pricier. Again, still pays a nice dividend. But you can see U.S. stocks lost 0.4% today, where international stocks gained. So what we're doing is the downside risk, we believe, is the same right now for European stocks as it is for U.S. stocks, at about 25% losses. In a horrific scenario, stocks could lose money. On the upside, U.S. stocks could make 50%. If the Jeremy Siegels of the world are right, the guys who come on CNBC and say that these are great times to be investors, and the Dow Jones is going to go to 30,000, 40,000, or whatever they're saying. Dr. Rabini is saying this is the end times. The crazy guys who are indicted by the SEC, like Porter Stansberry and other nut jobs who are out there saying that you should just buy farmland or whatever else. They're out. If they're right, stocks lose 25%. Again, the truth is somewhere in the middle. One of the reasons why we're not buying MLPs, one of the reasons why we're still not buying real estate or REITs, is our outlook isn't great for those. Now, investment-grade bonds, you can see here, don't do well in all three scenarios. So U.S. Treasuries, which if you look at effectively what U.S. Treasuries are paying right now, it's pretty horrible, right? I mean, a 30-year Treasury at the beginning of this year was paying 3.9%. Now it's paying 2.69% because, again, there's been a drive to fear U.S. Treasuries have done well this year. The 10-year is only paying 2%. That means if you give the government $100,000 and you buy a 10-year bond, you're going to get a 2% rate of return. That's not a very good rate of return, and that's not why you're paying us to manage your money. You get your 2% return. 2% is not going to get you to a comfortable retirement. It's not going to get you there. Also, whether it's a bear case scenario, investment-grade bonds do very poorly at 2.3%. If we have a base case scenario, investment-grade bonds, Treasuries do 1.5%. And if we have a bull scenario where everything's doing great and the Federal Reserve starts raising interest rates, then investment-grade bonds only make about 0.5% per year. Really terrible results. We think that high-yield bonds are a much more attractive asset class right now, which is why the last 5 years we've done very well and we've invested in high yield. Again, though, however, this year, high yield is certainly sold off. This concerns clients. Oh, no, the market's down, and we're going to talk in detail about some of our high yield positions. So we don't care what the price is worth right now. We care about bankruptcies when we're investing in high yield. So that's one of the things that we're going to discuss in detail. I'm going to unmute everybody here too, just to see if there's any questions to this point. I kind of gave the broad, 30,000 foot top-down macro explanation because we're top-down managers first. We look at the broad macro issues, what asset classes we want to be in. We look under 3 economic scenarios, why we don't think U.S. equities are as attractive as they are right now, why we're finding international stocks like Nestle and Unilever and particular oil companies a little more attractive, why we're not investing in real estate right now still, why we like high yield a lot better than TIPS or investment grade bonds, and then I'll kind of dig into the details from the bottom-up perspective next. But just wanted to get any questions that you may have out there and just kind of throw it out to the group. I know we have like 22 people on this call right now.
Jim, I got a question, Steve Smith. I heard in one program I was listening to that the drop in the price of oil may stabilize the Ukraine situation because Putin is not going to have the money to advance the war. Have you got any thoughts on that?
Okay. Yeah. So the question was
Jim, it went blank for me. Did it go blank for everybody else? This is Bob Delfano.
Yeah. Can you hear me all right? Can you hear me all right?
Yeah.
Yeah, I can. Okay. I can hear now, but it.
Oh, okay. I'm sorry. Maybe I muted myself there too. I don't know. So the question was, is it going to be more stable? Is it going to be more stable in Ukraine with lower oil prices? And the answer is maybe. Putin might behave a little bit more effectively. He may behave more if he's not able to make as much money. He'll have to get around with the world. Of course, he's a wild card, so you don't know exactly what he's going to in the short term. Putin may decide that he's going to act more irrationally. We really don't know. What we talk about on investment committee meetings, though, too, is what impact does this have on how many hamburgers are consumed in China? And what impact does this have on how many Barbies are sold in India? And if the answer is very little, I think that Russia's incursions into its neighbors is not new. And, of course, the global economy has gone on. The broader question, of course, is oil prices and what's this going to have to do to the broader economy. So any geopolitical issues that come up, if it's not impactful, if it's not going to lead to nuclear war, it's generally not going to be impactful to the portfolio. It's not going to impact in the longer term how many hamburgers are consumed in China, how much Nestle chocolate is consumed in Latin America, or how many Pepsis are consumed in India. Then we generally ignore that noise. And so from that perspective, it goes back to the broader question of oil. And I would say that lower oil prices is generally good for the economy. The rapidness of this particular decline has caused some uneasiness. And because it's happened so fast, it's caused a few people to obviously be worried about what's going on with the broader economy. And for junk bonds in particular, a lot of wildcatters and exploration companies aren't able to make as much money. And from our calculations, if they stay under $60 a barrel, they may not stay profitable. So that's an issue that we're doing a lot of research on within our portfolios. Crisis generally equals opportunity. While there's a lot of panic, I think that this crisis is there are some similarities to the financial crisis. It's not going to be as deep if oil prices stay low, but selling can beget selling, and fear can beget fear. And certainly, we can have further selling in the stock markets across the globe right now, and further selling, for that matter, for high yield junk bonds. So I'll kind of go into detail about those things too. But usually, again, it's important that we look at what's knowable and then what's not knowable, model for each of the scenarios, and try to find out where there's the most opportunity for us. Let me unmute you again too, and see if there's any other questions from a global macro standpoint. And does anybody else have any larger, broader questions about the asset classes in general before I get into detail about stocks and bonds?
Jim?
Yes, sir.
Jim, do you hear me, Lou?
I can hear you, Lou.
Yeah, I sent you a chat message. I don't know if you saw it or not, but I wanted to find out what is the time frame of this scenario you're talking about.
Okay, great. Yeah, so on the screen there, you can see that the bear market, base case, and bull market is a 5-year time horizon. I mean, I'm always honest in saying that nobody knows what the market's going to do in the short term. Everybody asks me at the beginning of the year, where do you think the market's going to go? And I always say I have no idea what the stock market's going to do month to month, day to day. I mean, look what the market did today. It went from the futures at 6 o'clock in the morning were pointed up 70 in the Dow. Then the market opened down, and then it rallied to 200 points or 100-something points. And then in the last 30 minutes, again, the computers took over and started driving the U.S. stock prices lower. So I always model for out 5 years, because a 5-year period is when the fundamentals take over more. In the short term, I never have any idea what the market's going to do. I'm sorry, Lou, I didn't see your chat. I did. Let's see. Marilyn, our client, asked here. Hi, Jim. You saying that purchasing U.S. stocks is not a terribly smart move? No, I think U.S. stocks are safer right now in the short term. There's certainly a lot of value, I think, in U.S. stocks. If you look at the stocks we own, remember we own about 75 stocks for our clients. And if you look at the stocks, it's a broadly diversified portfolio, and some are a lot cheaper than other stocks. Generally, again, if you look at just the fundamentals, P/E ratio is a way that you can, it's one way to gauge the expensiveness of a stock. So the price doesn't matter, right? You can have Berkshire Hathaway could be $150,000, and that could be a cheap stock. And you can have a penny stock that's worth $1, and that could be a very expensive stock. It really is the price divided by the earnings. So you can see Marathon Oil is one of the cheapest companies right now, is gauged by PE, whereas some of the more expensive ones would be Darden, which is actually one on our watch list. It's one that everybody hated. You know, Darden owns Olive Garden, pays a nice dividend for our clients. It's 3.8%. Again, as value investors, everybody hated Darden. Now it's done well for us. It's come up. It's been one of our better performers this year. So it's gotten a bit expensive. And you not only want to look at the price earnings, you want to look at the forward price to earnings and price to sales and price to book. And there's a lot of metrics that we're looking at when analyzing a stock. So there still are a lot of values out there in the U.S. market. Again, tech stocks that everybody hated. A lot of analysts and portfolio managers hated, like Microsoft and Cisco and Intel. Were very, very cheap at one point. Apple was very, very cheap at one point. Now those companies have run up pretty significantly. So there's still value in the U.S. markets. Our portfolio still is mostly U.S. based. You know, if you look at our overall portfolio, how we're positioned, then let me show you that too. Let me do a quick asset. So you can look at where we are, so asset classes, and you can kind of see the changes that I've been making for your portfolio too. Let me just show you the whole portfolio. So this is our composite right now. This is all of your, and I own the same stocks that you own in my personal portfolio. So you can see Abbott and AbbVie and Aflac and Apple and all the U.S. companies we own is 43.6% of our balanced portfolios. Clients who have a little less risk tolerance may, instead of owning 1% of Wells Fargo, they may own 0.6% of Wells Fargo. Our international stocks, we're at 16% right now. So as you can see, we're right about 60% stocks. Then of course our bond portfolio makes up most of the rest of it, 36%, and then we have one preferred issue, and then some cash to meet your cash needs. So that's what our portfolios look like right now. So we have been shifting, though. If you looked at us earlier this year, we've been shifting from, we were more overweight U.S. stocks, fortunately, and moving more and more into international stocks, including buying international stocks, which have gotten knocked around this year, and adding to those positions too, like recently buying Toronto TD Bank and buying Toyota recently, and purchasing Let's see what else. Diageo earlier this year. InBev, Budweiser earlier this year. So we've been finding some really good values overseas. Again, because our outlook effectively is that international stocks are probably going to outperform U.S. stocks over a longer 5-year period. Again, in the short term, on days when the market's scared, people might push into the higher quality U.S. names. But longer term, it's part of value investing is you want to buy the stuff that people don't like, and you want to, start selling if things get a bit too expensive, the stuff that's a bit overvalued.
Okay, thank
any other
you.
questions from? Okay, yeah. Any other questions from a broader macro level?
Jim, this recent omnibus passage included modifications to the Dodd-Franklin bill. The impact seems like it's going to shift the ability for low-income homeowners to get into the market again, to the home market. You see that as an issue for us again, to going back into the recession that we had just a few years ago?
No, I don't think. In politics, sometimes you can make money on politics, and I love when I get off a call or do a presentation and people say, geez, Jim, you sound like a Republican, or you Jesus sound like a Democrat. And I tend to be, you've got brilliant economists or money managers like Warren Buffett who are liberal, and George Soros, and then you've got some on the right who do very well also. And a lot of it in politics is just noise, because especially when you have gridlock, the Republicans, my friend Todd Young is a congressman in Indiana. He's a Republican. He's more like me, though. He tends to be a little more libertarian Republican. And even if he's more pragmatic because he served under Lugar in Indiana as a senator there. And even if the Republicans are floating ideas, it's not something that's not going to get done from a consensus standpoint. So there's a lot of things that may have on the margins some impact on financial institutions, let's say like Wells Fargo that we own or J.P. Morgan. Home ownership is really, right now, is a demographic issue. So if you take like Zach, who just left our office here in Raleigh, he's 29 years old, and he's younger, and younger people aren't buying homes right now. 30% of them, of millennials, are actually living with their parents, which is a problem. And some of you who are clients know this issue, or so, and have the kids living in your homes. So they're not buying homes; they're moving into the cities. Some of them don't even have cars right now. So that's going to be a detractor for real estate and mortgages. And of course, once interest rates start to rise, that helps banks on one hand, but you're not going to have as many refinancings also. So it's a little bit of yin and yang when it comes to it from a financial standpoint. We're still underweight financials in Europe. We don't own many financial institutions in Europe except for Banco Santander, Credit Suisse, and then HSBC. So I'm not sure I answered your question, but a lot of the stuff that goes on from a political standpoint is just noise. And I had lunch today with we were talking about energy, and certainly the CAFE standards could cause, as more fuel efficiency could be a good thing or a bad thing for the economy, but at the margin it's probably not going to have too much of an impact on Exxon's profitability. So it's something that we don't put much weight in. Did I answer your question?
Yeah. Well, again, some of the talk that's going on suggests that this is going to lead us back into the recession that occurred, or the reasons for the recession that occurred. And yeah. I don't know how deep they went into this modification. And so
there's a joke that we economists, we've called 10 of the last 6 recessions, and the guys who've been calling for a recession the past 5 years have been pretty wrong. If you look at a 5-year chart of what the stock market's done, up 76% over the trailing 5 years. How many times have you heard that the end was near over the last 5 years? Over the last 10. Yeah, it's been pretty. So the returns we've had for our clients over the last 5 years have been pretty extraordinary. And again, it's something that, our clients, we've had a nice balance portfolio, and we've had very nice returns. You can go to our website and look up our U.S. stock performance or just our bond performance. All of you are invested in our global income, which includes U.S. stocks, international stocks, and bonds. And of course, if you pull up a fact sheet over the last 5 years through September, we've had 11% annualized returns, 10% net, depending on the fee level. If you're a $2 million client or a $1 million client. So we've had pretty extraordinary returns over the last 5 years while a lot of people were calling for the end times. And there's a lot of people sitting in cash that don't know what to do. And again, I would say we don't know what the market's going to bring in the short term. We always tell our clients we always tell our clients to focus instead on the income. Focus on, like this slide here. That shows that right now our clients are getting about a 5% rate of return from our portfolio. So that's a pretty good rate of return. So if I brought up, let me do a quick report here of a portfolio appraisal of our portfolio. You're going to get from our U.S. stocks, again, not as cheap as our foreign stocks. So our U.S. stocks, energy stocks you can see here are yielding 3.7%. Material stocks are yielding 3%. Industrials are yielding 3.4%. So overall, our U.S. stocks, we're getting very nice yields of 3.3%. But international stocks, you can see energy stocks overseas are insane, right? Ensco and Transocean, should those dividends hold up, Seadrill has actually reduced their dividend. There's some worry that Ensco and Transocean not continue to pay their dividend. Generally, we're investing in companies where they're only paying out 50% of their earnings or less. So dividend's quite protected. I would say it's not as protected, obviously, in these companies. But you can see foreign companies where I would say they're going to be okay, like British Petroleum and State Oil and Total and others. You're getting a 5.9% dividend yield. It's pretty incredible. So overseas, we're getting a very nice dividend yield right now of 4.7%. That's a lot more than the U.S. Dividend. Again, if you just bought the S&P 500, you're only getting about a 1.8 or 1.9% dividend yield. So we're much more than that, and particularly much more than international. And then when you throw in all of our fixed income issues, and you go all the way down to the bottom of this portfolio, if you have a balanced portfolio with us, which everybody on this call effectively does, right now you're getting at current valuations. I don't know if I'm going to double your money over the next decade. I hope so. Again, that's the goal. But right now you're going to get a 5.4% current yield. So a lot of times people say, well, you should know when to get in and out of the market. Nobody knows that, right? If I knew that, I'd be God, and that's an impossibility. What I do know with pretty good certitude is that if we don't panic, if we come in there and just collect the dividend yields and collect what we're getting from our portfolio, we're going to get a nice 5.4% return. That's pretty strong. That's a nice yield, and that's because Pepsi might be down 10% tomorrow. It could very well be down 10% tomorrow. I don't know. But what I do know is Pepsi's probably going to continue to pay their dividend. So if we looked at, Pepsi today, or let's look at McDonald's, because everybody hates McDonald's right now, right? So I don't particularly like to eat at McDonald's because it's not that healthy for you. Although Chipotle is not that much healthier for you either. But if you look at McDonald's right now, again, U.S. company, but it's not really a U.S. company because a lot of its earnings are from overseas. It's selling at 17 times earnings, which is pretty reasonably priced for something that's a persistent earner. It's paying you 3.8%. It's making $5 a share. It's paying out $3.40. So even if McDonald's earnings went down a quarter, it's still going to pay you the $3.40 a share. It's still going to pay you 3.8%. So why would you panic and try to figure out when the market's going to go back? I know it's scary. If you look at just the demographics of our call tonight, usually we men are worse investors because we want to do something. We feel like we have to do something. I'd say we actually have very few women on the call tonight because women are better investors. They're longer-term planners. They hang in there. They don't panic. We men want to do something. We got to get in and out of the market. Oh my God, McDonald's is down 10% today. Let's sell it. Instead of saying, you know what, McDonald's is $88. I'm pretty sure that 10 years from now, McDonald's is going to be up to 200. It's probably going to double in value. But regardless, it's going to pay us almost 4% a year while we wait. We get paid to wait. And most of the returns, believe it or not, come in 8 to 10 days in a particular year. And you don't know what 8 to 10 days they are. Look at today. I mean, market was up, market was down. You just can't guess in the short term what a particular day is going to bring, never mind, month to month or year to year. All here, I'm muting everybody again here, just to see if there are any other questions about, as we start to delve into some individual stocks, just kind of open it up that and use that as illustrations for your questions if you have any regarding any individual stocks before we get into bonds too, because we're going to cover bonds next.
Jim, I had a question for you.
Sure.
How much of this, the oil price, obviously oil is priced in U.S. dollars, and the U.S. economy, the strength of the dollar has a lot to do with why the oil is going down. So,
I can't quite hear your question. I don't know if you're close to the mic or not. I know it's something about oil, but maybe if you can get closer to your microphone.
Well, I had a question. Can you hear me better now?
That's better, yeah.
So the fact that the U.S. oil is priced in dollars, and our dollars are stronger because Europe's doing badly, that's a big reason that oil might be going down. How is that impacting the currency fluctuations beyond just the oil issue?
Okay, yeah, so it was a little muffled, but I think you're asking about the currency fluctuations, and of course the ruble's fallen off, 17%. They've now moved the interest rate up, the Russian Fed up to 17%, and the ruble's falling quite dramatically. And the good thing for us in the United States is that we're still a default currency. You hear people talk about one world currency or some of the other. You'll hear about some people talk about some of the other issues out there, that the U.S. the dollar is going to decline and not be worth anything. And the good news is even our Congress can't screw up the strength of the U.S. dollar right now, because in reality nobody's going to buy rubles as a default currency. The euro is just not there, right? The Europe Union obviously has some severe issues right now between the northern nations and southern nations, Italy and Greece. The Swiss economy is just not large enough. So it'd be difficult for us to screw this up. It's possible that, again, we're not going to go to the yuan and Chinese currency. So there are currency fluctuations that occur. This happens more on a company-by-company basis. For example, let me show you. If you're ExxonMobil, you're going to benefit from a weaker dollar because your oil, effectively, I'm going to make this very simple because currency is a complex concept, but if you're ExxonMobil, 64% of your revenue comes from overseas. You're not really an American company. You just happen to be headquartered in America. Eventually, if you're in France and Exxon, if the dollar gets too strong, well, then you're not going to buy Exxon's oil anymore. You're going to buy Total's oil. So under that scenario, the dollar is appreciating and let's say the euro is depreciating. That could be good for foreign companies and bad for American companies. And then the reverse is true. If you have the dollar declining in value and you have the euro appreciating in value, then you're not going to buy French oil or Total's oil. You're going to buy Exxon's, especially if you have a favorable currency exchange. Currency things are extremely difficult, as you can see just in the Russian economy, to try to figure out day to day. So we don't hedge currencies, or nor do we speculate. I mean, there's some nutty professors out there, and they usually are professors, where the guys on TV will try to hedge and try to gauge where currencies are going. That's an incredibly speculative game to play, and one that we don't want to play. We want to buy good companies with good solid earnings. So Mattel may get hurt one year because the dollar is too strong, and in some years it might do a little bit better quarter to quarter. Over longer periods of time, currencies tend to mitigate because, again, if you're Hershey's, if the dollar is really strong, everybody will buy Nestle chocolate. But if the euro gets too strong, people say, even though I don't like Hershey's as much as Nestle's chocolate, it's cheaper, so let me buy Hershey's chocolate. And so the day-to-day fluctuations of currencies over longer periods of time, again, tend to mitigate out. And we're always looking over longer periods of time because I can know in the long term, from a fundamental standpoint, where the market's going to go. I can't know where it's going to go day to day or year to year, so we don't even try to hedge currencies because what hedge currencies does generally is hurt your returns by buying insurance effectively against everything that could possibly happen. Again, I've never seen a divergence like we have right now where stocks could lose 25% over the next 5 years or stocks could make 50% over the next 5 years. That's a huge, huge chasm. And it's one of the reasons why I like high-yield bonds, because high-yield bonds could make 4% in one scenario or they could make 4% in the bull case scenario. So I like high-yield bonds, and they may very well outpace stocks. I don't know. Even though high yield seems to be scaring clients even more than some of the declines we've had in oil. Let me unmute you and make sure I answered your question. Was that about what you were getting at?
I was just wondering how much of the strength of the dollar has impacted the price of oil, and oil is quoted in dollars all over the world, right?
You're wondering how much the strength of the dollar was helping U.S. companies, or
what's pushing oil down? I mean, is that since there's oil all over the world, but it's traded everywhere? That's maybe the strength of the dollar had a big impact on the decline in oil prices.
Oh, the strength of the dollar had a decline in oil prices. Yeah. No, not really. Right now, it's a pure supply and demand issue. What we have right now is it's truly the old supply-demand curve. We have a lot of supply. Demand is going up nicely, but not at the amount that supply, because we've had technological change and incredible innovation going on here in America, in particular natural gas. And fracking is allowing us to push out a lot of supply. So Saudi Arabia right now is fighting for market share. They don't want to lose their piece of the pie that they have. So they're saying we'll accept, because Saudi Arabia can make money at $20, $30 a barrel. United States companies, a lot of them, it depends. We're looking at maybe $60. Exxon CEO got on and said he'd be fine at $40. Every company's a little different, obviously, too. So it's hard to know, of course, company by company. Russia made their budget based upon $100 a barrel of oil. Obviously, we're not at 100. And just like anything, like the crises that occur throughout time, everybody was worried about Ebola a few weeks ago, literally, and now that's changed to energy. Nobody saw energy crisis. Nobody saw energy plummeting as much as oil prices have plummeted here in the last few weeks. And it's always the unknowable. It's the thing that hits you when you don't know it's coming, right? And that's effectively what's happened. If I put a 1-year chart here, let me put an oil futures thing on here, just the eye path of oil. You can see oil has come down 40% from the beginning of the year. I mean, that's an insane decline. Nobody saw that happening. Did you hear anybody? All the other crises that were out there were, Ebola or this or that or Europe crisis, or it's kind of like the financial crisis. Nobody saw that coming either. And again, that's why we focus on what's knowable from the fundamentals. The stock market's always going to do what it's doing. But regardless, during those periods of decline, we're able to get our clients the income they need to continue to retire. And although your $1 million portfolio might go down $800,000, it's still going to pay you $50,000 a year. And that's always our focus, is that, don't panic, don't sell Pepsi, don't sell McDonald's, because you're still going to get $50,000 a year. You won't get, however, the income from bonds that go bankrupt. So I want to talk a little bit in the next 10 minutes here about bonds. So high-yield bonds, of course, you can see, to go back to the chart here. Let me take oil off of this chart. High-yield bonds, identified by J&K and HYG are now down. Let me take the international index off here too. They're down about 6.5%, 7%. Our portfolio right now is down about 4.5%. What are we down? 5.17%. So if you look at our U.S. stocks, obviously they're doing well this year, up about 7%. International stocks getting hammered, especially because we've been buying energy issues here, down 16% now. Our high-yield bonds were down 5%, so overall the portfolio is down 2% on the year. This section here, because you buy bonds for stability, but again, I'm not going to buy you a 2% 10-year Treasury because that's not stable. Matter of fact, that's effectively guaranteed to get you failure. You're not going to be able to retire if I take your money. And even though the Barclays aggregate bond index is up 5% year to date, under every economic scenario, I'm not going to buy the Barclays Ag for you at a 2% yield. It just doesn't make financial sense for us to do it. However, we have to put up with these scary periods when high-yield bonds are down. So I think it helps when we talk about the actual names that you're invested in. And again, the other thing we do is stress test the portfolio. So this is a really bad scenario. Under a bad scenario where we go into a recession, high-yield bonds, in a worst-case scenario, make 4%. But let's say we just have a horrific downturn. One of the things that we do is we stress test the portfolio, and we say, okay, what if we have 30% defaults? Now, the funny thing is, if you look at this J.P. Morgan slide, that's back here on page of our presentation. Where is it? I'll find it. Maybe I won't. Where is that J.P. Morgan slide? Oh, maybe I don't show it on this one. Yeah, I don't have it on this one. So the worst case scenario that happened actually didn't happen during the financial crisis that we had. I'm going to pull that actually up. Let me get that presentation for you too. 'Cause I do.
You're muted again. We can't hear you.
Can everybody hear me okay?
No.
Yeah, we can. We couldn't before.
Yeah, I apologize. I don't know what happened. I don't know if a battery went out or something there. I apologize. I just went to a new phone.
Your audio off for at least 5 minutes.
Yeah, I know it was off there for a bit, so I apologize. I'm going to get back to talking about bonds here. So I got you on speaker. It's working. Let me go back here. So we started talking about individual bonds, and one of the things I wanted to talk about individual bonds is stress testing for a worst scenario. So when you look at a worst case scenario, when you look at a worst case scenario, if somebody could chat to me too and say that they can still hear me right now, I appreciate it. They could somebody could chat me back, make sure you can hear me. Okay, good. Thanks, Kim. So one of the things I want to talk about too is the J.P. Morgan slide that you saw, and unfortunately couldn't hear me talk about, was a worst case scenario. And when I look at the worst case scenario, 15% default rates was very bad and happened during the savings and loan crisis. So when I was getting out of the Marine Corps back in 1991, let me find the slide here. It's the global income. Let me go to the unconstrained fixed income scenario. So we stress test for a worst case scenario, and back in 1991 or the early 90s, we had a savings and loan crisis that was pretty severe here, as you could see, and we had 15% default rates, and that was a rough period of time. Spreads now have gotten a lot wider just recently, and generally you have between a 5 to 7% spread between a riskless treasury right now at 2% versus where we can get in the high yield market. And overall, so if you look at high yield under bear and base case scenarios, we're going to make a decent rate of return. However, I want to look at what happens if we have just a horrific scenario. And this scenario here is actually worse. The savings and loan crisis of the early 90s was worse than what we went through the financial crisis as far as defaults were concerned. So we use that as a base case scenario and say, okay, what if we had 30% defaults and we only had 35 cents on recovery, meaning if you have a default in the bond market, we're first to get paid. We're like the bank. So they're going to pay us back. Now, Eastman Kodak only paid us 15 cents on the dollar last year. Edison Mission paid us back 90-something cents on the dollar. So sometimes you don't get back as much as you had hoped, and that's left up to a bankruptcy judge generally. In this case, we use 35 cents on the dollar as a broad measure of an average recovery. At our current yield that we have on our portfolio, which is about 8.5%, we would still get a 2.6% rate of return. 2.6 is still better than you would get from a U.S. Treasury. So even in a horrific scenario of high yield defaults, you're still going to get back more than you would get from a U.S. Treasury right now. So although go down and people may get nervous, as long as you don't panic and sell that individual bond, then you're going to get that rate of return. So again, I can even stress test from a global macro standpoint. Let's say 20% of our portfolio right now goes bankrupt completely. 20% of our holdings, 20 of the bonds go completely bankrupt, and we get zero recovery, zero payback, which is unlikely, but let's say it happens. We still get a 2.8% rate of return over the next 4 to 5 years. Still better than the U.S. Treasury. This is why we like high yield, because the downside risk is not that bad, and the upside return is 8.5%. That's pretty good. And so again, in managing risk, now again, the short term, it goes back to everybody panicking. You get on CNBC and they say, hey, it's time to sell. Oh my God, the end is near. Junk bonds are down 7%, sell. The benefit of you is that you own the individual bonds.
So if I managed all of your money in a big pool, well, and I owned Burger King, Burger King just paid us back last Friday. So it's always nice to get paid back. You hate getting paid back early, but when we lent money to Burger King, 8%. So Burger King says, hey, we're going to give you your money back. Well, let's say McDonald's was beating up Burger King, and Burger King wasn't the great turnaround story that they were when we bought them. Nobody liked them. And what happens is that everybody says, oh, my God, Burger King's going to go bankrupt and sell. Well, if Mr. Smith calls us up and he says to sell his Burger King bond, he only hurts himself. He doesn't hurt the whole portfolio. If we're managing a mutual fund, I then have to sell Burger King, which in turn hurts every other client who's in that portfolio also. Now, you'll still see we may be the only person selling Burger King that particular day. And in that scenario, you'll see that $10,000 bond go down to $9,500 because one person had to sell it on that particular day. But as long as Burger King doesn't go bankrupt and you hold it to maturity, you're going to make that 8% rate of return. So we stress test the portfolio from a macro standpoint and look at the global macro impact and say, hey, what if 30% of the portfolio went under? What if we got 0% recovery? We still get a positive rate of return. We're still getting a 0.1% rate of return, which is still terrific, right? I mean, that's still almost as good as a treasury right now. So the downside risk is very limited right now in the high yield market. Again, it's going to be higher for some of these wildcatters. We've had Quicksilver Resources, an effectual default, going to go bankrupt. We're always going to have some names that go bankrupt on us when we're getting paid that higher return. But the downside risk right now is pretty limited, and it's one of the reasons why we really like high yield bonds. So to talk about a specific name too, just to pick one out. Again, right now the portfolio is getting about an 8.5% rate of return, even a little higher due to the reason that now it's about 10.5%. As you can see this, I'll highlight this for our portfolio here. It was 8.5% at the end of the quarter. Now high yield prices have gone down even further. So if we have no defaults, we're going to get a 10.4% rate of return. We're not going to get 10.4 though, because some of these companies we own are going to go bankrupt. Ram Global is a wildcatter. Ram Global was a nice, profitable company, family-owned type business. CEOs been managing it for 60 years. Great company, but sometimes when you borrow money at the wrong time, if they don't get a lifeline, if they don't go bankrupt between now and October of next year, we're going to make a 66% rate of return. But they might not make it. If oil prices stay below $60 a barrel, they might not make it. Even if it goes back up to 80 in the short term, they might not make it. And that's okay because, again, it's not, as a percentage of our portfolio, it's not going to destroy, because in your portfolio it might be 0.1 or 0.2% of your portfolio. It's not going to decimate your nest egg. You can see we own about, we manage about $200 million. Ram Global, we own $658,000. The current value is $460,000. So it's not going to decimate our portfolio that we're managing for you. It's not going to decimate your personal portfolio because we don't put too much in any one bond because we know we're going to have bankruptcies. Colt Defense is having trouble with unions. It's having trouble with restructuring. They lost a major gun contract. You could have spikes with Colt Defense where with the defense contractors, they lost things can go wrong in the defense industry too, where a particular company may be fighting headwinds and it has to go into bankruptcy. If they don't go bankrupt in November of 2017, then we're going to get a 48% rate of return. It's a huge rate of return. Again, they could go bankrupt and maybe we get 40 cents on the dollar for Colt. Maybe we only get 20 cents on the dollar. And that's really left up to the bankruptcy judge. Let me unmute everybody too. Now that I'm talking about specific names, kind of open it up to you for your questions about a particular company that might be out there. Does anybody else have any questions about a particular name? No questions? You can still hear me, right?
Jim, can you hear me?
Yes, I can hear you.
Have you talked about precious metals? I was off the air for a while.
Yeah. So Precious metals, with gold prices going down pretty significantly this year, we've been lending money to gold mining companies. So, for example, Anglo Gold was that we bought earlier this year. Let me try to find Anglo Gold here in our mix of names. It's not near as stressful. When we bought Anglo Gold, the yield was about 8%. I think the Anglo Gold can make money with gold prices at about $800 an ounce. Gold is difficult, like oil, especially in the short term. Gold is difficult to value. It's highly volatile in the short term. Right now, it's at about $1,200. So mining companies, are you talking about debt? I imagine, right? The bonds that we've been lending.
Yeah.
So on the debt side, we've been able to find some really good value. I'll mute everybody here again here, just quickly here. Okay. So on the debt side, Anglo Gold and other mining companies that we've been buying for our clients, the yields have been pretty good, and as you can see, you know what? Let me do it this way because I'll be able to find it much faster if I just pull up our whole bond portfolio here. That way you'll be able to see it. Consolidate it. The other thing, too, that's interesting is one portion of our portfolio is getting hit while the other is doing well. So high-yield bonds are about 15% of the index, as you can see. And our portfolio is about 19%. It's a little less now with the price declines. If you have lower energy prices, though, if people have more money in their pocket, then the consumer discretionary side, then they have more money to gamble at casinos. They have more money to spend on clothing. They have more money to spend on tobacco. They have more money to spend in hotels and specialty retail stores. So one portion of our portfolio might be declining faster than the other, but this side of the portfolio is actually going to be helped by lower energy prices. So I did want to talk about that just briefly. Let me make this bigger here. It's going to be all the way at the bottom since Anglo Gold is a foreign bond. Okay, so you can see it's one of our larger positions. So we have $983,000 face value. We only paid $902,000 for this particular bond when gold prices were kind of plummeting and everybody was panicking. Again, we're value investors, so we only paid, and let me kind of show you this from a math perspective too. If we did this, make this a little smaller. Because bonds are complex, although they're simple in some ways, they're complex in others. So here's Anglo Gold. As long as Anglo Gold doesn't go bankrupt between now and April of 2020, we're going to make a 6.1% yield to maturity. Now, the yield was higher. It was closer to 7-something when we initially bought it, because you can see now the market value is $950,000. So you're making money on two sides. One, you're making the coupon is 5.37. So let's say we invested $1 million in Anglo Gold. Under that scenario of the $1 million, you're going to get paid $50,000 a year. And actually, in this case, you're going to get paid, $53,000 a year in interest payments, as long as Anglo Gold doesn't stop paying us and go bankrupt. The price could fluctuate. Gold prices could plummet, and everybody goes, "Oh my God, gold is going down. We got to sell gold mining companies. They're going to go bankrupt." Then you can see that maybe we paid par for it. Maybe we paid $100 for it. It goes down to 90. There's more risk, and that's what we did. We bought it at about, as you can see, at about 91. Now the price, people realize, oh, gold's stabilizing, so it's gone up to 96. Oh, geez, Anglo Gold's not going to go bankrupt. And again, that's where crisis to us equaled opportunity, and we were able to buy that particular issue beaten down valuations. We still like it. We're still buying it. We're still going to get a nice 6.1% rate of return for new clients who are becoming clients today. So it's a terrific yield for our clients to get. But it kind of shows you what happens. Now, again, if you may see it going down and think, oh, my God, we got to sell this. It's like, no, you don't want to panic. You don't want to sell Angle Gold right now any more than you want to sell, Ruby Tuesdays. If Ruby Tuesdays or Rite Aid drugstore doesn't go bankrupt between now and 2020, we're going to make, with Rite Aid, we're going to make a 7.5% rate of return. And with Ruby Tuesday, we make a 7.9% rate of return. And with lower energy prices, our energy positions are getting hit, but there's more money in consumers' pockets, and they're able to spend a little bit more money at Rite Aid drugstore. We recently bought a lot of cosmetic companies, right? So like Revlon, which you can see right above that, Revlon's yielding 5.7%. Elizabeth Arden is one we've been recently buying for our clients also. You can see Elizabeth Arden is yielding 9.3%. Again, the coupon rate is 7.3, but we're buying it at a discount, so we're buying it less than the $100 par value. We're buying it at 94. It's gone down to 91. So as value investors, what do? We buy more. As long, again, as it's not more than 0.5% of your portfolio, we're adding to those positions because we don't think Elizabeth Arden is going to go bankrupt. And as long as people keep losing makeup, you're going to make a 9.3% rate of return. Now, this is what we try to walk clients through. We say, don't panic anymore. You're going to sell McDonald's and lose that 3.8% dividend yield. Don't panic and force us to sell Elizabeth Arden. This is where we're finding value while others are panicking, while Jim Cramer is saying, oh, my God, it's the end times, or somebody else, other analyst is saying, Elizabeth Arden is going bankrupt. We're getting paid for that risk. Now, I could be wrong, and Elizabeth Arden certainly could go bankrupt. And I'm mitigating that risk inside of our clients' portfolios, again, by not buying too much of any one particular issue. And we talked about the worst-case scenario. Again, 30% defaults and only a 0% recovery over a 4-year period. We basically get our money back, which is about the same as putting your money in the bank right now or in a U.S. Treasury. There's no return. The upside potential is 10.5% from current yields. Pretty good chance of nice returns. So I just want to talk about some specific issues in the bond market and what we're doing and where we're finding value right now and where we've been wrong too. Like some of the areas where the portfolio is extremely stressed are these issues which I look at on a daily basis. Harris has gone bankrupt on us. Quicksilver is an effectual default. XI went bankrupt on us last year. Radio Shack, if they don't have a good Christmas, they're hanging by a thread and they don't get a lifeline. Ram Global, I talked about. Colt Defense. Coal companies are struggling right now because natural gas is so cheap and oil is so cheap that people aren't buying coal. And coal companies are really struggling. Gymboree's a specialty retail store for like kids' clothes, higher-end kids' clothes. They're struggling. The nation of Venezuela is struggling with oil prices plummeting. Although they've always paid back their debt. Maduro, you don't know whether or not he's going to continue to keep up Chavez's principles of paying debt because he doesn't want to lose power. If he didn't pay his debt, he could lose power. So these are, you can see a lot of energy companies, especially the wildcatters. Heckman just provides services to clean up natural gas. They're not even directly in the wildcatting type business, but that portion of the portfolio, energy in particular, has been certainly stressed. And we're finding value there. So we're not panicking. When there's blood in the streets, we're usually buying. And then, of course, companies like Sears and JCPenney. If Sears doesn't go bankrupt, we're going to make an 18% rate of return. Claire Stores, which is like the crap that my daughter buys, the ear piercings and stuff like that, if they hang in there, we're going to get 15, 16% rates of return. So we're finding a lot of value in the retail sector right now, too, or JCPenney, which is yielding 11, 12%. Let me unmute everybody again. And just open it up for your specific questions you may have about a particular bond or anything else. I know I've been talking for an hour and a half with an interrupted couple of minutes there. I apologize for. So we talked about the broad economic picture, our outlook. We talked about how we look at the world, where we could be wrong, which asset classes we think are the best to invest in. U.S. stocks are not really cheap anymore. They're providing a little more safety in the short term. We're finding more value in Europe. We're starting to invest more in Europe, and you're seeing that with us buying Toyota or in Japan, obviously, and Budweiser. We're not investing in real estates or MLPs because they're still pricey and the yield isn't there. We're certainly not going to invest in 2% yielding treasuries, because when interest rates rise, high yield is not as sensitive, and they're going to get killed like they did in 2013. We're finding the most value in the high yield market, where we think the downside risk is limited. The upside potential is huge, especially at these valuations right now. Although certainly we could have more of a downturn. So our focus to our clients is always the same, and our strategy is very boring. But we tell our clients, hang in there, collect the dividends, collect the interest payments. You won't have to go back to work. If you don't need them, we're reinvesting those dividends and interest, and you'll get it. This strategy is a boring way to invest. Instead of investing in some crazy stock that might go up 100% like Tesla, it might also fall down and do very poorly and doesn't pay a dividend to you. So with that, I'll kind of throw it out again to you. Again, like why we wouldn't invest in Tesla? Well, we're not going to pay, first of all, not even making earnings, but even if we looked at their forward earnings right now, the Tesla's selling at 68 times earnings. If anybody wants to pay me 68 times earnings for my company, that's probably the one time I would actually sell it. It's just crazy to sell it. And again, I have to pay myself a dividend. That's my salary. Tesla's not paying you anything. That's why we don't buy. Why we're buying McDonald's instead of Chipotle. I eat at Chipotle. I like Chipotle. Mexican grill. It's good food. Might be a little healthier, but we're not going to pay 50 times earnings for a bean burrito. It's just not going to happen. Especially when they're not paying us a dividend. We will pay, 17 times earnings for McDonald's and collect a 3.8% dividend. And that's a much better way to invest with less volatility in our lives. Although, again, in the short term, you're always going to have some fluctuations. Over longer periods of time, the reason why we've done so well over the last 17 years is it's a tried and true strategy of value investing, which is difficult when everybody is panicking. But we think that dividends and interest keeps our clients invested and keeps you retired. So, again, I'll open up to any questions you may have about a particular bond or anything else that's on your mind. Anyone else? Nothing else you want me to cover or want to go over? Or there's got to be more questions out there. All right. Well, I guess I've talked to you. I guess I've talked to you to death, and maybe you're probably all eating, not even listening, right? But I appreciate you tuning in. I know there's a lot going on, and again, when you're investing, you got to try to tune out all the noise. You're better off sometimes turning on the History Channel and more reading a good book rather than wanting to do something based upon what the market is doing today. You got to think longer term, which is why we always model for a much longer term time frame, and why we're investing for a longer time, because I don't know what the stock market's going to do in the short term. Does somebody have a question? All right, well, I'll wrap it up then. If nobody has any questions, then thank you very much. I really appreciate you tuning in and taking a night that you could be out Christmas shopping. So as always, I appreciate the trust that you put in our firm. It's a large burden that I don't take lightly, and obviously think about this stuff on a continual. I didn't prepare anything tonight. I just kind of went stream of consciousness. That way, kind of let you know what some of our thoughts are, and kind of let you guide some of the presentation.
We've been saying that for years.
Thank you very much for your continued trust, and it's deeply appreciated. Have a wonderful. It's the first night of Hanukkah. Happy Hanukkah. Merry Christmas to everyone out there. Have a wonderful holiday season. As always, feel free to call at any time. It's deeply appreciated. And good night.